Bill Gross of Janus Henderson. He manages a small portfolio there, as he has for decades, across the bond environment. He is most interested in our economics and the future of the nation as well. Bill Gross, wonderful to have you with us today. I've got to go right away to the Fed Derby. Can Chairman Powell be a good chairman under crisis?
Well, maybe, but he certainly hasn't had an experience during crisis. I mean, he's been there for the past 5 years. His experience is really in private equity as a salesperson rather than investing. I'm not sure what he knows about the interworkings of the financial system. I would vote for Paul McCulley, ex-PIMCO. He's the one that brought us the Minsky moment. He's the one that basically saved PIMCO. He's the one that would have done a better job during the Lehman crisis. But Powell reminds me of G. William Miller, the last real economy chairman just before Volcker, and he didn't last long because he didn't know much.
Of course, not certitude that Mr. Powell will be selected, but certainly that is, I guess, the speculation is how I would put it, folks. Then with that, Bill Gross, we have to look at John Taylor and Janet Yellen. When you look at these two esteemed economists, how much do they cross over in their economics? How much do Chair Yellen and Professor Taylor overlap in their economics?
Well, I think a lot. I think both, Tom, are model-driven, perhaps different models. We know about the Taylor rule, which speaks to real interest rates relative to unemployment into what they call NAIRU, adjusted as it is. Yellen basically has been model-driven. She's, focused on several models as we've gone through her tenure, and so I think both are that. They are model-driven, and I would argue that model-driven Fed chairmen or Fed members are not what we need at the moment. We need a subjective type of Fed chairman that's able to look at structural factors such as demographics and debt and delevering and technology in terms of its influence on inflation going forward, as opposed to a Taylor model that looks at the past 20 to 25 years.
Very good. We'll get to the debt and the deficit here in a moment, folks, with Bill Gross of Janus Henderson. Bill, I want to bring up the chart that is acclaimed with your call from 2.6% down to 2.40%. As Scarlett Fu mentioned earlier, we're there now. The lower yellow line is 2.40%, distant from where we were in 2007, the red circle. Bill Gross, what are you doing in your portfolio now to adapt and adjust to this new level on the 10-year yield?
Well, remember last month I spoke that level, 240.45, had to be broken, I guess, to signify a structural change in the long-lasting bull market. It hasn't been broken yet. But, I would suggest this. If the Fed is serious in terms of, 2 or 3 hikes going forward, that puts us at 2% Fed funds, and with the 10-year Treasury at 230 or 235, there's not much value there. Why would an investor take 7 or 8 years of duration risk, longer-term maturity risk, versus short-term securities at 2%? And so we're getting to the point where there's not much potential for capital gains in the bond market. And ultimately, as I suggested, if that 240, 245 level is broken, perhaps some capital losses.
If there's a capital loss, which I believe, Bill Gross, is yields up, prices down, can we do it with stability, or does it make for significant volatility and the emotion that comes with it?
No, I think we do it with stability, and the reason is that quantitative easing is still being employed by major central banks in Europe and Euroland and Japan. Still $1 trillion worth of money is coming into those markets, and if the German 10-year is at 35 basis points, it's still attractive in terms of U.S. Treasuries. So those markets, I think, continue to dominate the U.S. Treasury market, even if 240.45 is broken. And so it will probably be gradual.
Bill, I think we're going to see something on tax reform tomorrow. You've written about the nation's fiscal position, our financial responsibilities to generations to come. And what is so stark to me, Bill, and you and I remember this in 1986, is the level of debt at that time. Bring up the chart, Tania, if you would, here. This is the debt of the nation summed up and all you need to know is Ronald Reagan's over on the green circle and President Trump's over on the red circle. Can we do tax reform, Bill, given the sum total of our debt and our annual deficits?
Well, not really, in my opinion, but you know, what's $1 trillion between here and there, I suppose. Let me point out, Tom, and this takes a longer time than you have, but in terms of U.S. liabilities, the present value of Social Security and Medicare and Medicaid probably 3 or 4 times the near $20 trillion debt that you know, the U.S. has at the moment. And so, you know, ultimately, these types of liabilities come back to haunt us. And another trillion or another $1.5 trillion is really not a positive for markets or for the economy.
Well, you speak, Bill, there of the research of Lawrence Kotlikoff of Boston University. This is really important, folks. The sum total of our obligations is far greater than what you typically hear within the media. If we get a rise in interest rates, can we be complacent if we get the 10-year back to 2.8%, the 10-year back to 3%, or does that new higher yield really begin to impinge upon our financial system?
Yeah, I think it does. And you know, many analysts, Tom, will talk about not until 3.5% or not until 4% on the 10-year Treasury. I think the U.S. economy, as we've just spoken to, is more highly levered than it used to be. And so a 50 basis point move in a 10-year Treasury, while you know, long ago was not a particular problem, now it is, because not only the Treasury, but corporations and individuals are much more highly levered. And a 30-year mortgage at, say, 4% versus 3.5% makes a difference in terms of cash flow and in terms of present value. So I think 50 basis points, it doesn't produce a recession, but it certainly stops an economy in its tracks, in my view.
Interesting. One more question, Mr. Gross, if we could. You mentioned the future Vice Chairman, Paul McCulley, there, and talking about the Minsky moment. That would be something to see, Mr. McCulley as Vice Chairman. But, Bill, when we look at a Minsky moment, that seems to be an endogenous shock that comes out of nowhere. Are we near a Minsky moment at the end of 2017?
No, I don't think so. You know, Minsky moments come when, you know, security as opposed to insecurity is built into market stability versus instability. And I don't think we're there, certainly in most of the world, but in China, of which we know not much, you know, certainly highly levered and has the potential for a Minsky moment, although, again, you know, highly controlled in terms of capital markets. But leverage ultimately, Tom, leads to Minsky moments. It's just a question of when. I don't think it's now.
Bill Gross, thank you so much for joining us after this Fed meeting today. William Gross is with Janus Henderson.